You don't need thousands to start dividend investing. With $500, you can build an income stream that grows on autopilot. In the next few minutes, I'll show you exactly how it works and how to start today. So what is dividend investing, really? Let's break it down to the absolute basics. A dividend is simply cash that a company pays you for owning its stock. Think of it like this. You own a tiny piece of a business. When that business makes a profit, it can choose to share some of that profit directly with its owners. You are one of those owners. That cash payment is your dividend. It's a thank you for being an investor. These payments usually come on a predictable schedule, most often quarterly, so you get paid 4 times a year for each dividend stock you own. And here's the crucial part. You get paid that cash regardless of whether the stock price went up or down that day, that week, or that month. This isn't about chasing fast gains or timing the market perfectly. Dividend investing is about generating a steady, predictable cash flow and letting it grow over the long term. For example, if you own 10 shares of a stock that pays a $1 dividend per year, you earn $10 annually. It's that simple. It arrives in your account in chunks throughout the year, quietly adding to your bottom line. Now, you might be wondering why you do this instead of trying to find the next hot stock that's all over the news. The simple reason is that for beginners, chasing hype is one of the fastest ways to lose money. You're trying to predict the future, competing against professional traders and algorithms. Dividends flip that script entirely. They reward patience, not prediction. You don't need to time your entry perfectly. You just need to own a piece of a solid company that pays you to hold it. Dividends create real, measurable returns even when the market is just moving sideways, going nowhere. Let's be very clear about this. This is not a get-rich-quick strategy. It's a get-paid-consistently strategy. It's about building a reliable foundation, not gambling on a lottery ticket. It's boring in the best possible way. Okay, so you're getting these small, consistent cash payments. What do you do with them? This is where the real power comes in. It's a concept called DRIP, which stands for Dividend Reinvestment Plan, and it is the engine of this entire strategy. A DRIP is an option you can turn on in your brokerage account that automatically takes the dividends you receive and uses them to buy more of the very same stock, or even a tiny fraction of a share. You don't have to do anything after you set it up. It happens on autopilot. Here's how the magic works. Let's say you invest your $500 into a stock or fund that pays a 4% dividend. That's $20 a year. With DRIP turned on, that $20 doesn't just sit there. It's automatically reinvested, buying you a little more of that stock. Now you own slightly more shares, so the next time dividends are paid out, your payment is slightly larger. And that slightly larger payment buys you even more shares, and on and on and on. It's the definition of compounding, happening quietly in the background, year after year. This brings us to a critical point and one of the biggest mistakes beginners make. They chase high dividend yields. They see a stock paying an 8, 10, or 12% dividend and they jump in thinking they found a gold mine. But an unusually high yield is often a warning sign, not an opportunity. It can mean the company's in trouble and its stock price has fallen, which artificially inflates the dividend yield percentage. The risk is that the company might have to cut that dividend entirely, and your investment could lose value. The real power isn't in a flashy high dividend. The real sustainable power comes from a solid, reliable company and that automatic reinvestment from DRIP. Always remember this rule of thumb. Consistent dividends plus reinvestment is far more powerful than a flashy, high-risk dividend yield. Don't chase the number, chase the quality of the business behind it. So what can you realistically do with $500? You're not going to be living off the income tomorrow, and that's okay. The goal here is to get the compounding machine started. You have 2 main options. First, you could invest in 1 or 2 dividend ETFs, or exchange-traded funds. An ETF is like a basket that holds dozens or even hundreds of different dividend-paying stocks. This gives you instant diversification, which is a great way to lower your risk. Your other option is to buy 3 to 5 solid individual dividend stocks from different industries. Now, you might be thinking, $500 won't even buy 1 full share of some of the best companies, and that's where fractional shares come in. Most brokers now let you buy a slice of a share. So if a stock costs $200, you can invest $50 and own a quarter of a share. You still get the dividends proportional to what you own. This is a game changer for new investors. So let's set expectations straight. With $500, you are not buying immediate income. You are planting a seed. You should expect to see growth in the number of shares over time, not a pile of cash in your bank account next month. As you start, it's just as important to know what not to do. So let's call out the most common beginner mistakes to avoid. First, as we just discussed, chasing the highest yield. It's a trap. Second, ignoring dividend sustainability. Before you invest, do a quick check to see if the company has a long history of paying its dividend and if it can actually afford to keep paying it. Third, panic selling during downturns. The market will go down. It's a normal part of investing. When you sell in a panic, you lock in your losses. Dividend investors see downturns as an opportunity for their drip to buy more shares at a lower price. And finally, overtrading. Don't constantly buy and sell. The whole point is to buy and hold, letting drip do the work for you. Remember this line: dividend investing fails when people get impatient. So how do you actually start today? It's incredibly straightforward. Here are the 5 steps. 1. Open a brokerage account with a reputable firm that offers fractional shares. Most of the big names do. 2. Go into your account settings and enable DRIP, or Dividend Reinvestment Plan. This is a crucial step. 3. Deposit your $500 and invest it into a diversified dividend asset, like a low-cost ETF. 4. Make sure it's set to reinvest automatically. 5, and this is the hardest part, leave it alone. Let the system work. Don't check it every day. Just let your dividends get reinvested and let the compounding begin. This strategy won't make you rich this year. It won't even make you rich next year. But if you stay consistent, if you let your dividends reinvest and compound for decades, you are building a genuine income stream that can one day make a real difference in your financial life. If you want a starting point for the exact ETFs or stocks that many beginners use, check the description for some ideas. Thank you for listening, and remember to like and subscribe for more straightforward investing advice.